for, for questions, and if not, you can write them on the chat, or you can ask the questions afterwards when we are done. Okay, so
sounds good. While Pancho's pulling up my slides, I'll just summarize or forecast what I'm going to talk about, which is we're always in a state of uncertainty about where crop markets are going. For the cotton situation, there's an above average amount of uncertainty related to both the demand side and the supply side going into this year. So go ahead and flip it to the next one just to see where the price action has been. Going back 12 months, we've had prices over $1. We've had prices rising. We've had prices plunging. And here lately, for the last 2 or 3 months, we've had prices in a rather narrow sideways trading range. And that's sort of reflecting the uncertainty. They don't know whether to bust out to the upside or bust out to the downside. So they're kind of rocking along this way, waiting for kind of a dominant influence. What happened previously with those major rallies and major declines was there was a dominant influence. It was either we were worried about the drought or we were worried about weak demand. And right now we're not certain how to size those up. So let's look at them individually. Go ahead and flip it, Pancho, to the next slide. And I'm going to talk about the demand picture. There's a whole lot we could talk about. If I was given a 30-minute presentation, I'd talk to you about the possibility of a recession and the Federal Reserve raising interest rates to fight inflation and how that slows the economy and how that hurts cotton demand. All of that is a consideration. This is the most direct picture or explanation of the demand picture for cotton. We export most of our cotton, and this is a graph of exports. That's what the blue peaks and valleys are. And what I want to show you with this is here lately in the last couple of months on the far right-hand side of this chart, we've had a lot of unexpectedly weak demand that is low, very low, minor blips up in blue. That just is saying we didn't sell very much cotton when the price was low, when I would have expected us to be selling lots of cotton. But then there's a couple upticks you can see in January. And so that got some people thinking that maybe demand was recovering, maybe demand was normalizing. We'd sell 300,000 or 400,000 bales in a week, which that's good when we can do that. The question is, what's going to happen for the next 6 months? Will we have normal levels of demand over 300,000 per week, or will it slip into low gear? And I don't know the answer. Nobody knows the answer to that question. I am worried about what the Federal Reserve is doing in raising interest rates to slow inflation and keeping those interest rates up for a period of time. That's the economy, and to the extent that happens, people tend to buy fewer apparel and home furnishings, and that just works its way back down the supply chain. So again, we'll have to see. But the big question mark, there's a big question mark on the demand outlook. We have to see how it unfolds. Go ahead and flip it again, Pancho. On the supply side, we've got questions about the 22 crops still. This chart is basically kind of shows the historical adjustments to USDA's forecasts. We had a March forecast where for the last 3 months, they've projected that the 22 crop was going to be, whatever that number is up there, 14.68 million bales. There are a lot of people I know, a lot of people on Twitter, a lot of farmers saying there's no way that we're going to harvest 14.6 million bales. There's no way. We haven't ginned that many. We haven't classed that many bales at the classing office. There's just no way we're going to, with the drought as bad as it was. And while they've been saying that, USDA has been holding to this estimate, and the level of ginnings and the level of classing, bales classed, has been rising to sort of bridge the gap. And when it all works out, we're probably going to have 14 point something million bales. And the long and the short of that is the people that have been waiting for a downward revision in the size of the 22 crop are not going to get their wish. It's in the sense that it's not going to cause a big price rally. That's what people have been wanting. They want USDA to come back and cut the size of the crop, admit they were wrong, and cause a big rally in the market. And I don't think the rally part of that's going to happen. So sorry. Let's think about the 23 crop. Go ahead and flip it, Pancho, to the next one. There's still a lot of questions about the size of the 23 crop. We've got, beginning with the acres planted, the price ratios, which is what this chart is, would still suggest that we're going to have a historically low level of cotton plantings because price of corn, just to pick one competing crop, is still high relative to cotton prices. And if that ratio played out according to history, we'd probably have less than 10 million acres of cotton planted. But on the other hand, flip the slide again, the early season indicators of acres planted represented by measured with a couple of early season reports that have been out, they've measured over 11 million. Cotton Grower Magazine was 11.5 million. The National Cotton Council was 11.4 million. USDA kind of assumes that the Cotton Council number would be 500,000 fewer, but all of that's higher than what I would have expected. So the market is waiting. The next acres report is going to come out at the end of this month, and everybody's going to watch it. Everybody's going to look hard to see if it's surprisingly high or surprisingly low. And then we've got another one at the end of June. And, as always, the market's going to pay a lot of attention. But this year, they're going to pay more because it's a real question. And it matters to the outcome whether we have 11 point something million planted or 9 point something. One of them gives us a very tight situation. The other one gives us kind of takes the edge off the short supply question. So we'll have to see. Flip it again. Regardless of how many acres we plant, it's dry, and it's dry from top to bottom of Texas, except in East Texas. So we got to worry about abandonment, and even La Nina is over officially. It's still dry, so we're starting off with that kind of a situation. Abandonment could be high, or we could have timely rain. So big question mark again about the size of the crop based on acres planted and early season crop conditions. And that'll play out. Go ahead and flip it, and I'm winding up my presentation here. You could, with all the uncertainty and the question marks I've laid out, we could have a couple of kind of extremes that we could paint. One would be, well, what if demand is recovering and we have a short supply? That is, we only plant 9 million acres and we have high abandonment and we have strong demand. That could be a super tight situation. And if that was to play out, then that would give us the scenario for the highest prices going into this year. On the flip side, we could plant 10.5 to 11 million acres and have a few timely rains and have an ample supply of cotton. And if that was to play out, plus not the strongest demand in the world, we could end up having more cotton than we need, and prices could weaken from where they are. So I've laid out those paths graphically. Go ahead and flip to my next slide, which is the last one. The two extremes of higher prices or lower prices are shown with that green line versus that blue line. And again, it all depends on how much we end up planting, how much we end up abandoning, and what the demand picture is like. And I really don't know the answer to those three variables right now, but as it plays out, that could put us on a different price path that would give us stronger prices back up into the 90s, bust us out of this sideways price range we've been in, or not. And the worst case scenario is that we have prices kind of slip from where they are now in the mid to lower 80s and go sideways a little bit, but then slip back under 80 cents. And that's, again, that's possible if we plant the high end of acreage and just have regular abandonment and then only have weak demand. So I haven't answered any questions about where prices are variables this year. And so we'll have to watch it play out. And I'll stop there, Pancho.
Great, thank you, Don. Let me stop sharing. Any questions for John? David, if you want to put your slides on, upload your slides.
How's that?
That's perfect. Thank you.
Great. Let's see here. All right, let's jump in. I'm gonna talk really all about cattle this time and hit 3 or 4 points of things that are going on in the marketplace right now that I think are pretty important or at least interesting. The first thing is, hopefully this doesn't steal too much thunder from Mark's presentation, who's up next. I'll let him talk about. You guys okay?
It's up on our internet.
Okay, just heard a couple of comments, just so making sure it wasn't a question. I don't, like I said, I don't want to steal anything from Mark. Mark will tell you why, but you know, I think for calf prices and this big run up we've seen going on, one of the first big reasons going on is simply feed costs, corn prices. So you know, there's a pretty good decline in corn prices happening. And if we looked at this year compared to last year, last week we were at about $7 in the Southern Plains. We were over $8 per bushel a year ago. And so, you know, more than $1 lower feed cost compared to a year ago, just, you know, in terms of corn prices, that's fueling a whole bunch of this rally in calf prices that we see going on in our local auction markets. I think that's a pretty important factor in higher prices. Let me show you a couple of these higher prices here. Here we go. There's 500 to 600 pound number one steers, Southern Plains. Boy, just prices skyrocketing, and really, you know, feed costs are part of that. I think that's a big part of it. It's just plain cheaper corn. But certainly, you know, I think there's some other things. We got fewer calves around. Certainly, you know, in some parts of the state, we've had some pretty darn warm weather over the last 3 or 4 weeks, and some grass growth and things like that as well. So higher prices there. If we're looking at 7 to 8s, you know, feeder cattle ready to go to feedlots, certainly higher prices there as well. Fewer supplies, but also cheaper feed. I think that's really playing into our higher calf prices and feeder cattle prices. The second big reason for higher feeder cattle and calf prices is really the fed cattle market. If you take a look at steer prices, Southern Plains, we were at 165. Gosh, I mean, just sharply higher. I mean, just a heck of a spring rally going on in terms of steer prices. And a couple of things are driving that. One is certainly cattle slaughters down. We're moving. We have fewer of those animals on feed, and the demand for the cattle is there. The demand for cattle from packers, and I think it also argues that regardless of everything else going on, Federal Reserve action to try to bring inflation down, you know, the demand for beef is still there. So far, consumers continue to buy, and that's leading to higher prices for fed cattle. So we combine these higher fed cattle prices and cheaper corn. It makes this rally in calf prices, and some of these prices we've seen make a lot of sense. And if we look at further out, we've had the fed cattle futures market later in the year at $1.70, $1.72. Really some strikingly high prices for fed cattle. So, you know, really that expectation of high prices is fueling this feeder cattle run too. So that's sort of what's going on there in terms of prices and why feed costs and fed cattle prices. I thought I'd turn our attention briefly to beef cow slaughter. Y'all know how many, we ship so many beef cows, not only in our region, but nationally to slaughter. Last year, as shown by that dotted line, which is 2022 weekly beef cow slaughter, we've had a heck of a decline. Some of that is seasonal so far this year. We do tend to see beef cattle slaughter decline a little bit from January to, February, March, even into April. That tends to be a little lower time of the year for beef cattle slaughter. But we've really seen some, over 10,000 head a week decline from mid-January to today. So, quite a few fewer beef cows going to market. Dairy cow slaughter is about the same as it was a year ago. So total cow slaughter is actually down. And so, just fewer of them going to market. How many did we pull forward last year? Did people really kind of get their herds sort of set? Now we're going to wait and see what happens with rainfall or whatever. But regardless, certainly fewer going to market. And a lot of volatility in the cow market in terms of prices, but really, prices pushing 80 cents at auctions in the Southern Plains. So certainly higher prices. And you might remember we do tend to see the cow market increase from the fall of the year into the next year, really getting into May and sometimes June. But, seasonally prices do tend to increase. We start pushing where we get towards grilling season, we get more demand for trimmings, more demand for hamburgers, and that really feeds right into the cow market. So certainly a lot of volatility from week to week, but generally higher prices on the cow market. Cattle on feed, the next USDA report comes out Friday. I thought I would just show this to say, I do pre-report estimates. I've got placements at down about 3.7% from a year ago. I'm, among the analysts, I'm a little bit on the high side for placements, but I'm really fewer placements and fewer cattle on feed. I've got in my expectation of this report, cattle on feed down about 4.1% from a year ago. So heck, fewer cattle on feed, really continuing that trend. And I think, that's going to be pretty supportive of prices as we go out later in the year, just simply that there's, fewer cows, fewer calves, fewer cattle on feed, and tighter beef supplies going on. So that's something you might watch for in that report that comes out Friday afternoon. Thought I'd hit trade for just a second, beef and veal. And the part that I really wanted to mention was just really imports. We imported a lot of beef in January. And I think the interesting part, if we were to pull out of this, the big player in imports was Brazil in January. All of this 300, almost 70 million pounds we imported, 104 million pounds of it were from Brazil. So 29% of our imports came from Brazil. And what's driving that is really, with we've got higher prices. It makes us an attractive market. Brazil, in terms of their access to our market, they are part of what we call the other tariff rate quota. So really, the way these work is that there's a level of imports that triggers a much higher tariff. And so what they're trying to do is get a whole bunch of beef exported here at the low tariff before the high tariff kicks in once we hit those quantity levels. And so they're really trying to beat the TRQ and by that I mean ship a bunch of beef here early to use up that quota level before the 38% tariff kicks in. And so if you want to know more about TRQs and how that works and the amount that different countries can ship to us under different tariff levels, let me know. I got a pretty good short write-up on that, and I'd be happy to share that. But really, I think the main thing is Brazil's shipping a bunch of beef to us. because they're trying to get it in before the higher tariff kicks in. And I think they did the same thing last year in that, so that dotted line that trends lower throughout the year is really related to, you know, some of those higher numbers were trying to beat the tariff last year and get in ahead of the tariff. So we've got some more of the same thing going on, but certainly higher prices will, you know, make us an attractive destination. So I think Brazil's the interesting market there, at least for now, in terms of what's going on in trade. The next thing I wanted to mention, I'm gonna roll the dice and take a chance here. Bobby McCool and I were talking. He called me right after the last one of these a month ago today, and said what he would, you know, he was interested in and really wanted to talk about. If we think about the drought 10 years ago, and prices went to record high levels as cattle producers, as rainfall happened, pastures recovered, and we started expanding our herds, you know, prices declined or collapsed really quickly. And I think a lot of us expected some of those high prices that they would last a little longer. Maybe not the record highs, but those high prices would last longer, but they didn't really turn out that way. And so as Bobby and I were talking, I said, I tell you what, I'm gonna talk about this next time. So now it's next time. Why did cattle prices fall so fast last time as we recovered cow numbers? And certainly a problem that some people have faced when they bought some really expensive heifers. They may still be paying off some of those heifers now. And so, you know, thinking ahead about expansion, how to expand, why did prices get to record high levels, and why did they decline so quickly? I think there's a couple of key things to think about. What I'm going to suggest is, one is that we rebounded our cow herd much faster than folks thought we could. And the second thing is really about, here's where I'm taking the chance. I'm going to say something about economic theory for a second, about the elasticity of demand and how prices respond to shifting supplies. So, you know, really the two keys are those. We responded much faster than I think folks thought we would or could. And then this idea of elasticity of demand. So, you know, let me show two charts. One is our cow inventory, and the red line, I'm going back to 93. We get to the depths of the drought a decade ago. Following the drought, you see us increasing cow numbers after that. And if we looked at this data by 2018, in the US, we had more cows than we did before the drought hit in 2011. So you think about just that short period of time, we really increased our cow herd pretty rapidly. And so probably more rapidly than we all thought we could. And so that very quick rebound in response to record high prices, folks responded to those economic signals and we expanded. And I think that's one thing to keep in mind, is just simply how fast we responded. I think the other way to think about how fast we responded is not, you know, in addition to the cow side, but let's look at beef production. You know, 14 and 15, we got down by 15. We were under 24 billion pounds of beef production. Really, as we pulled heifers out in 13, 14, and 15, we held those heifers back to expand the cow herd, which means they didn't go to beef production, and that really crunched beef production, which led us to those record high prices. But take a look at this pretty rapid growth. Within a year, we were over 25 billion pounds. We hit 26, almost 20, that was 26.9, 2 years of 27 billion pounds, and then 2 years, you know, 21 and 22 of over 28 billion pounds of beef production. So, you know, if we think about this, if we go back to 2010 before the drought at 26.4 billion pounds of beef, by 2017, we had the same amount of beef production as we did before the drought. And so, you know, this idea of why did prices decline so quickly is, you know, I think fundamentally because we responded so fast in terms of beef production. Now, here's where I'm going to take a chance here. And I just drew this out freehand, just like I'd have done it in class. But if we think about supply and demand, I've got this price on my up and down axis. I got quantity on the horizontal axis. And really all we're measuring is, and John had a couple of charts sort of like this too, with the dots and years of, price and production, or price and acres planted. We tend to draw this and think about demand for cattle or demand for beef being that straight declining line. I got a D on there for demand. So as supply changes, we realize this price 1, price 2, and price 3 in the marketplace, and we think about that as being a straight line. What I'm going to suggest to you is the way we might really ought to think about it is that this line is curved. And the more we cut supply, the more we get to, here's my technical term, more inelastic demand, meaning that our price responds much more than the quantity change. So look at that change in price from P2 to P3 as we shift supplies back. So what that should tell us is if demand really looks like this, we get this much higher price, and we can think about that being the record high prices of 14 and 15, yet it didn't take very much expansion and prices collapsed back down to this P2. And so really we ought to think about this as this nature of demand being much more price responsive to supplies. So again, we rebounded a heck of a lot faster than I think most people thought we could. And that's because folks responded to record high prices, but also that nature of demand led us to a sharper price and quicker price decline. So let's think about this time around, particularly as I think I'm getting a lot more questions from folks about how to respond, how to rebuild. What about this time? We're still in drought, so we still have that issue, and really it hinges on rainfall, our ability to expand. But compared to a decade ago, our costs are much higher. A decade ago, beef demand, we went through a period after that, beef demand was very good. I think we got some uncertainty there, but so far beef demand's very good. How fast can production respond? Heck, does it rain? I think we have to have higher prices because we got higher costs of production, and those have to come together over time. So, this speed of response, I think, is pretty important. And I think that's a little bit of an area of some uncertainty. But with that, I want to suggest a couple things we might start rolling around in our head. And one is who should expand their cow herd, and how can they do it? We had folks last time that had to sell their whole herds because the drought was so bad. And so they've started buying heifers and cows really at the top of the market because they had to start over. Some of those guys are still paying for some of those cows and heifers because they were simply so expensive. How we expand, that process of expanding, can we use, if we didn't have to sell the whole herd, we can use that equity in our existing herd to leverage and buy some more cows. I think that makes a difference in our ability to expand, and really relates to, instead of having really high production costs because the cows cost so much, we've got some slightly higher production costs because we're not replacing the whole herd. And I think the other thing we ought to think about in our minds a little bit is sort of stress testing. If I buy some really expensive heifers as expansion starts, how much can I stand prices declining and that speed of price decline as everyone else expands as well? So those are a couple of things I'm thinking about in terms of prices and how long it takes to expand. So hopefully that's useful in kind of thinking about there. Pancho, that's my last slide. I'm going to hit end show. Hopefully I can stop sharing.
Excellent. Thank you, David. Thank you,
And
Lord.
sorry I took a little longer than usual, but I thought that was kind of worth it based on talking with Bobby last time. So
No,
I look forward to any
very
questions.
interesting, and I think given the drought, we are all discussing that. So I think that was great. Hey, I have two questions in the chat.
Oh, great.
One is says, is the import from Brazil box, carcass, or live animals?
It's all beef. It's certainly not live animals. Really, our only live animal imports for meat come from Mexico and Canada. If you think about it, we're shipping lots of, You know, if you bring in live animals, you're shipping lots of bones and water and hides and stuff. You know, it's really beef. I would probably suggest that most of it is trimmings that go into ground beef. You think about lean beef trimmings from a lot of grass cattle. That's really what that stuff is coming in. That's a good question.
The second
I
question
see
is-
that on there, Pancho, about the quality of beef.
Yeah,
You know, as I would probably suggest that because most of it is lean beef trimmings. You know, if you think about kind of hitting a hamburger or ground beef market, we need a lot of lean to go with the fat that comes from our fed cattle. So in that regard, I might say quality is as we might think about USDA quality grade, meaning marbling and things like that. The quality is not prime and choice. The quality is lean beef trimmings going into ground beef. Hopefully that
Great.
answers that question okay. I'll keep watching for the chat, but I'll turn my camera and mic off and let Mark take over.
Mark, whenever you want to start.
All right, very good. Thanks again, Pancho. Always good to be with y'all. And yeah, I'm going to touch on some themes that we have heard already expressed in our program this morning and build on that from the grain perspective. Hope you can see those all right. And again, looking at the fundamental factors that are driving our grain prices, you know, a lot of pieces that coming together, a lot of uncertainty, obviously, this early in the spring is here in the U.S. as we're getting you know, the primary planting areas, particularly for corn and soybeans, driving our grain price outlook. And then, of course, that very important relationship of determining price at the end of the year is that stocks number relative to use. That pile of grain that's left over at the end of the marketing year, how big of a cushion does that leave us going into the next year? And so we'll look at some factors, I think, influencing that and perhaps give us some insight on price direction as going to this year. Talk about the influence of high prices. And to put just in some perspective on that in the grains, these are the base prices set by the RMA, the Risk Management Agency, for crop insurance purposes. And I've got soybeans, corn, grain, sorghum, and wheat represented in this chart. And I just want to look at the last couple of years, 22 and 23, how high that base price is going back to 2006, that we're in record high price territory, and the influence that that's likely have on grain production and incentives for grain production in the near term for 2023. If you look at soybeans, the last 2 years, record high base prices. You look at wheat, that for 2023, that is a record high price for wheat going back to 2006. Grain, sorghum, and corn, the green and the red line for sorghum, we had higher prices in 2011, but that's it. Otherwise, these are record high prices as we go into the crop year. And then the influence of what that base price establishes in terms of revenue, I think that's very important as well. If you look at the guarantee that's created by these record high prices. And so I'm using kind of some Texas examples here. I'm looking at the prices that are set for 100 bushel corn, 30 bushel beans, 60 bushel sorghum, and 30 bushel wheat. Using those yields, these cash grain basis levels, and then a 70% revenue production product. If you're using those calculations, what would be the minimum revenue guarantee established by those parameters? And going back to 2021, 22, and 23. And again, with the prices that we've established this year, holding steady with corn, holding steady with grain sorghum, we're seeing the revenue considerably higher, that minimum guarantee for wheat. And then if you look at soybeans, still a relatively high revenue guarantee, down a little bit this year. And so I think that has some implications then for what might be planting decisions and risk management strategies going forward for 2023. If we see, you know, those revenue guarantees holding stronger for our grain markets, a little bit softer on the oilseed side when we look at soybeans. Well, what about our input costs for 2023? And of course, if we're looking at one of the primary input cost factors that we've got for grain production, that's the cost of nitrogen. And I'm using an example here of putting out 130 pounds of N. which would be kind of a typical nitrogen application in a lot of central Texas, maybe along the coastal bend. Certainly nitrogen prices are significantly higher than we've seen over the last couple of years, doubling from 21 to 22, but now they're backing off a little bit. Nitrogen supplies are a little more abundant, prices are coming down, and so if you're looking at prices this spring compared to a year ago, our nitrogen costs are some $20 to $30 an acre cheaper this year, which certainly boosts that profit margin for some of our grain crops. And again, if our revenue guarantee is holding steady and some of our input costs might be backing off a little bit, that's a little more positive for the projections for that profit margin moving forward 2023. So I think that puts in perspective to some degree what some of the might be drive some planting decisions this year. And as USDA reflected in their Outlook forum, I'm certainly looking for an increase in corn acres nationally this year. Soybeans holding about steady, but I think this is kind of some of the numbers behind how we got to those kind of expectations. At the Outlook forum, USDA's projection is something just over 90 million acres of corn, soybeans holding about steady, and some increase in wheat acres. Significant rebound there from about 45, perhaps to 49 million acres. We do have the winter wheat crop, certainly larger this year. Of course, the spring wheat plantings still to come. But I think that kind of maybe explains what maybe some of the drivers separating our corn acres in 2023 from what we're seeing happening, particularly in the soybean market. As was mentioned, the weather outlook perhaps looks more positive going into 2023. This is the forecast path of the La Nina, El Nino forecast that we're seeing. We're now emerging from that La Nina pattern. We're emerging into the neutral zone for kind of a not a significant impact of direction from La Nina or El Nino. But yet, by the time we get to next fall, perhaps entering back into an El Nino phase, which would be more favorable for winter wheat production, particularly in the southern high plains. And the news this week that this was the final La Nina advisory. That La Nina has ended. And so we haven't been able to say that for about 3 years. And so it's finally good to be able to get that behind us. And so protect something that looks a little more normal on the weather outlook moving forward. What would normal corn yields look like? Again, I think that kind of trying to make the case that we're going to see an increase in corn acres this year. And if you look at corn yields in that outlook forum from USDA, we're seeing numbers in the 180s. That's pretty astounding when you think of a national corn yield. We've been in the 170s for several years now. Can we actually get up to a 180 bushel corn yield? Well, if the trend line production tells us anything, going back to 1950, this could be the year that we could break that 180 bushel corn yield barrier. And this is the kind of the spreadsheet, the balance sheet that USDA put together with that Outlook forum. If you look at that increase in planted acres, from 88.6 to 91, 2.4 million more acres. Look at a yield going from 173 to 181. That's 8.2. That gives us a corn supply increase of about 8% compared to 2022. That's a pretty big change from one year to the next. What about on the demand side of the equation? Yeah, they've got total use up a little bit, but relative to supply, demand only growing by about 4% relative to a supply increase of 8%. And so start thinking about what that does to our ending stocks number, supply increasing relative to use, and the influence that will have on price. Looking at as an 8% increase in supply, a 4% increase in demand, that puts that downward pressure on price down by about 16% going into 23. So I think if we do see that increase in acres, better growing conditions this year, moderate increases in demand, that days of use on hand supply, that pushes from a 32, 33, 34 day carryover up to a 47.5 day carryover is what's projected by USDA in their current estimates. So a significant increase in that stocks to use number and the downward influence that have on prices. Not as low as we've been the last 10 or 15 years. I think again this higher cost environment maybe boost the floor on what that price impact could be. But yeah, corn back to the $5.50 range, I think that's very reasonable. And that's kind of what I'm looking at for 2023. Certainly higher prices, higher cost. The margin's relatively tight, but perhaps again with some lower input costs, giving some advantage to corn acres relative to some of our oilseed crops. Acres are up, yields higher with normal weather this year. However, that increasing that stocks to use ratio, particularly when it comes to corn and wheat, putting a moderate downward pressure on prices. The biggest concerns that I have outside of weather would be the overall impact of the global economy and global trade. In that do we go into a recession officially in the U.S. or more broadly in 2023? Will global trade particularly continue to be access to those Black Sea markets? That's the one that's the real question. Do they keep this Russia-Ukrainian deal that will allow that grain to flow out of that key region, or it's at threat, it's at risk as long as the war goes on? But certainly those agreements are certainly critical for maintaining our access to those markets. Pancho, that's all I brought to share this morning. Glad to be with y'all, and be glad to take any comments or questions if there's anything else that would come up at this time.
Mark, thank you very much. Great presentation. Do you all have any questions? Let me stop recording. Do you all have any